And good evening. We are live. So I've got Roger on here with us. This is Ryan Munn in Vermont with the Vermont Crypto Mastermind, talking a little bit about all the excitement in the markets today and in the past, the past month and a half, right? And let's see, we're looking at what a 70. We saw a total, what, 82% retracement? Was that what it worked out to?
Yeah, I think so.
Yeah.
It's probably one of the biggest roller coasters you'll ever ride.
Absolutely, absolutely. So what we've been discussing is the wave theory that Roger talks a lot about, and we've both talked quite a bit about and observed how things have flowed through the market in terms of capital and some of the influences on this recent drop and kind of where things are sitting at and how things have worked in some ways the way we knew they would, but felt they wouldn't. Is that what we were saying?
Yeah, exactly. This is the third time I've gone through the wave, and of course, the wave starts with the most recent low of Bitcoin, and then what happens is Bitcoin takes the lead. Bitcoin, of course, was the first, and many people view it as still the best currency. And so when you get to the end of one wave, then Bitcoin is you take off, and then you can follow it. You can see it just like you would a real wave, crest, and then crash on the beach. And the challenge is to surf the wave without getting caught, in the crash. And if you surf it well, you can actually roll from one coin to the next, and you should be able to double or triple your profits as opposed to a simple buy and hold strategy. And that's really the goal in trying to understand the wave theory.
Absolutely. So now we've had a few surprises. We kind of anticipated that the holidays would lead up to an influx. And it's interesting because we weren't wrong, right? There was definitely a lot of news about the number of accounts that were being opened. Some of the exchanges were even limiting the number of accounts they could open in a day because they were getting backlogged. But what we were just, kind of coming to is that holiday activity wasn't a big enough volume to really drive another holiday wave like we expected. What those were retail buyers jumping in and throwing their $1,000 or $10,000 or even $100,000 at this. And that money wasn't really enough to carry into another wave when there's really major players have been into this market for the past couple of years. And over the past year, especially, some really, really big money has come into this market. If you look back at those volume surges in the cycles over the past year, and that volume of money with the ability that it has to influence the market was much, much more than the retail influx after the holidays, in my opinion. And that's why what we're looking at now is you've got the people that got into the holidays going, oh, it's back down from 17, they're buying in at 15 or they're buying in at 14, and then they sell out, and then they buy in at 10, and then they sell again when they see it going down because they're panicked and they're not the mob mentality sets in where they're buying high because they're fear of missing out, and then they're selling low because they're afraid they're going to lose it all.
Yeah, well, I agree. So the Christmas holiday season, the Christmas holiday buying spree never happened.
Right. Well, it happened to the ICOs, right? And all the alts. We saw these 100%, even some of them went up 50 times. It was crazy.
Yeah, absolutely. But the Christmas buying spree never happened. So that's the thing that threw me off, because going into the Thanksgiving holiday, Bitcoin was the only coin that really had any luster on it. It was taking off, but the other alts were just starting to make a move prior to Thanksgiving. And by the time Thanksgiving came around, people were making some serious money in the alts, and that kind of spurred a rally. And so because it was the Thanksgiving holiday was so successful, and of course that carried into December. But because Thanksgiving was so successful, I was expecting that Christmas would be even more successful, because you've got a lot more people and you've got this longer holiday, more chance for people to go home and tell them about their successes over Thanksgiving and how they were going to make so much money that they would tell all their relatives. And then by the end of New Year's in January, I was expecting this mega rush.
Right.
Never happened. And it didn't happen for a couple of reasons, right? One was because people had made money in Thanksgiving, and I think they were a little bit more cautious in December because it had just gone up. And the second reason was at the same time, the exchanges and the governments around the world were stepping up the regulatory requirements, you know, the know your customer rules. So they were making it harder for newcomers to get into cryptos. You know, you have to show your passport, and then you have to wait for approval. And then there were a ton of people who tried to come in, but the exchanges actually had to shut down or suspend opening new accounts because there were so many people trying to come in. So you take that along with the fact that, you know, Bitcoin goes into a 2-month decline starting on December 16th. And people are watching this. They're going, well, I'm not going to jump into this with Bitcoin crashing, the best, you know, coin in the industry. And so that, I think, had a chilling effect. So a lot of people were very cautious here. So what we haven't seen is the Christmas buying spree. And I think what we're going to see over February, maybe the end of February now, into March, are all these people who got set up on the exchange, who have weathered the storm because their portfolio has gone down. They probably started small, but then they'll start to see some gains. Once they start to see some doubles or some triples, that'll encourage them to put more money in going into March. And so the wave, if you will, really got extended quite a bit longer. And I think we're going to see the next one just starting. Oh, I think you're on mute.
Yeah. All right. So I think there's a couple other factors in terms of just profit taking too. And we saw obviously a banner year in cryptos, banner year in Bitcoin. And then at the very end, we saw those huge jumps in some of the alts. There was some savvy traders taking advantage of that. And at the end of the day, you know, money in Bitcoin is still money in Bitcoin. It's not necessarily cash in your pocket. And so when people are going to take profit off of those, you know, 100%, 200%, 300% swings, they're going to cash out. And if it's me, you know, if I'm seeing, you know, those kinds of banner profits on a large portfolio, so I'm talking large investors, they're going to re-diversify, right? They're going to diversify into maybe non-crypto assets. Or you've got these young guys, you've got, you know, like your son, right? You know, might have had a banner year, you know, and had a huge return, and go, oh, well, maybe I should cash half of this out and put it into an IRA, you know, like my dad said. and so there's all these different factors playing in. And then, of course, there's a tax bill, right? If I got a bunch of capital gains and I'm seeing Bitcoin at $20,000, probably a good idea to cash out and put some money away to pay the tax man, you know, as opposed to taking the risk that it's gonna, you know, crash and burn, and now I've got, you know, nothing left to pay my taxes with. So there's all those factors coming into play right now because there's serious players coming into the game.
Yeah, well, we're going to get another shot at it. So you know, I think right now everybody should be thinking about ramping up for the next cycle, buying the best coins and tokens. Because we're already seeing it, right? So we've had like 4 crashes in the last 4 weeks, and each time, you know, those are really instructive for me because which of the coins jump back the first? Which ones are the last ones to go down? They're reluctant to go down until that wave sort of crashes. It takes them all under eventually, but if you look at some of them, they just don't want to move until things are really bad, when there's really blood in the streets. Then everything goes down, but they were the last ones to go down. And then when things come up, they're the first ones to come up. Those are the best, usually those are the best coins and tokens, and those are the ones you want to hold. So that's what I've been looking at the last 3-4 weeks is, you know, which are the best ones that I want to have, and just trying to position it for the next wave. Yeah.
I've been watching, you know, that top, I like to separate out the coin market cap by the mineable coins to really get a sense of where that core, that sort of middle range of the wave is in terms of those, like you're saying, those real competitive coins, the ones that hold on strong while Bitcoin goes down or come up fast right after it does. You'll see, you know, Zcash is one that I've been watching a lot of that on. And Cardano, I think, was it you and I and Steven were discussing the other day. That's an interesting one, though, because that one's not mineable, actually, I think. It came off the list split it up?
Some of the things that are happening is that we're seeing more of what used to be second tier coins start to be considered solid coins. So a lot of the platforms, even ones without projects, are much stronger now than they were certainly 3 or 6 months ago. Cardano is one that came out of nowhere and that has gotten a lot of momentum and seems to have a certain amount of strength and resistance. And these are, other platforms. It can be EOS is also another one that went down for, must have gone down for 6 months in a row before it finally turned around.
Yeah.
But now it's one of the stronger platforms because now it's seen as, quote, an Ethereum killer. It's one of the key rivals to Ethereum. And you've got some other competitors, strength. So it's not just about Bitcoin. And you and I were talking about Bitcoin dominance. So in the last downturn, what we saw was Bitcoin dominance rise from roughly 30% up to 60%. And that was because as the market went down, there was this flight to quality, this perception that Bitcoin's a better one. There's this sort of a speculative air. The rising tide lifts all boats. So everybody rushes into all these different coins. They all go up. They all go up 2, 3, 4, 5. But then when the market goes down, that's when you see, which of the strong ones are, because the strong ones will go down a little bit and they'll retain their value because they have greater network effect. Their projects are further along. The weak ones will drop like a rock and they won't come up until the next rising tide. And so what that did in the last wave was it created Bitcoin dominance. Bitcoin became one of the only ones, and it got so exaggerated that by November, Bitcoin was equal to 50%, more than 50% of the market. When you think of all the 2,500 other coins and currencies out there, pretty amazing that Bitcoin still in November was more than half of the market. But I think it's different this time. So we saw Bitcoin's dominance drop to 35%. We're now seeing sort of the end of the last wave, and this is the point at which Bitcoin dominance should rise if it's a flight to quality, if people believe that all these altcoins are too speculative and they rush back into Bitcoin. We're not seeing that as much at this point, and I believe we won't see it. I would be surprised if Bitcoin dominance gets above 40% at this time. And I think it's going to be it's natural that Bitcoin would be diluted by all the other coins and projects over time, no matter what. But I think we're going to see a much different market this time where there's much more across the board strength. There are a lot of interesting projects. Some of them are in beta. They're coming out and they're showing a lot more strength.
Yeah, no, I agree. And I think it's the other interesting thing that we didn't quite get to was I had been looking at some numbers to analyze really just the top 15 currencies or even like the top 10 mineable coins and comparing the Bitcoin dominance value in that way to those more comparable currencies. And really, that's where most of the market is. I mean, most of the market is in the top 15 coins. So really, that's where that movement's going to be happening. And so if Bitcoin gets up to 40% relative to those coins, that's not a huge shift realistically when you consider the other 1,500, 2,000 coins out there. And I think it's reasonable that it's not really going to climb back up to 50, 60, 70% just because there's going to be a constant influx of new coins coming, and every single new launch is millions of dollars added to the market, and that's just going to continue to dilute that perception of Bitcoin dominance. But there's a whole other aspect of Bitcoin dominance that we never really talk about because we're really looking at just the market factors. But there's also the whole aspect of actual hash power securing the blockchain and the network that's actually contributing to that. And that's a level of dominance that is why you saw that swing back to Bitcoin and why you see Litecoin holding on and even Ethereum holding on, because Ethereum still uses a decentralized mining infrastructure, whereas these fixed currencies like, say, Cardano, I don't know exactly how that is being secured. They're talking about basically a smart contract system that has an intrinsic token, but it's not actually produced through any securitization. So that's something that I think needs a little more research. Maybe Stephen knows a little bit more about that.
Yeah, I don't have the answer to that. I'm wondering if they actually have a working platform yet.
Yeah, I don't know. I know NEM has a similar kind of thing that they've talked about, a smart contract platform, but I haven't seen much in terms of functionality except a wallet that holds tokens.
Yeah. Well, so you bring up some interesting points. And I think the challenge is to figure out, you know, which of these other coins or tokens are the ones that you want to be holding, because you can just hold Bitcoin. And right now it seems like, well, it's an easy double if it just goes back to where it was a few weeks ago.
Right. Yeah.
So that's not rocket science, as long as you believe that, you know, cryptos are going up, they're not going away. You know, Bitcoin seems like an easy double here. But, you know, if your goal is to maximize your portfolio or to accelerate, you know, your acquisition of wealth, assuming that you're in it for the money, and a lot of people are. So if this is really about, you know, your financial security, then you want to think about, you know, coins other than Bitcoin, and which ones. Now there are 2,500 out there. So do you just, you know, put, you know, $10 on all of them and hope that one of them is going to go up 1,000%? Or do you, you know, try and make some educated guesses? You know, first of all, it's impossible to watch 1,000 coins. So if you put $10 on all of them, you'll never know when to sell the right one.
Right.
So that strategy doesn't work too well for me unless you have a lot of time to just look at them. But you can get familiar with the top, you know, 20, 30, 50 coins. And you can make some educated guesses as to which ones you think have the greatest potential upside. And if you pick a good combination of them, they should outperform Bitcoin. And so that's really the challenge, is picking that next generation. And this is kind of exciting times, because a lot of these projects are getting closer to fruition. And now we're seeing a lot of strength in the market that goes beyond Bitcoin.
Yeah, well, you know, you say that strength in the market, and yet the whole market followed Bitcoin down for the most part. So the only strength is in those top 15. The rest of the market has really shown very little strength. And we also have to recognize that most of the traders in this market are trading with Bitcoin as their base currency. And they're not in it to make money on the project. They're in it to make money off of the retail buyers who are out shopping for their coin, like you, and are going to go in there and buy at what they think might be a good time to buy, or when they feel like it might be, you know, they might be missing out on the opportunity. And the traders are out there making the money, and they're valuing everything in Bitcoin. They may be valuing a little bit in Ethereum, but the reality is that they're valuing it in Bitcoin, and some of them have a strategy of actually basing in Bitcoin, but then liquidating to Litecoin to, you know, resist volatility.
We don't have to play their game. We can take their money just as well as they take ours, because one of the challenges,
they're already out of each of those markets.
Yeah, but then they have the problem of getting back in. So it's
but they're in Bitcoin. What are they going to get back in for if they don't believe in the value of all these altcoins, and they realize that most of the true future secure contracts are going to be built on top of the most secure core layer, and maybe a couple core layers.
Yeah, but those traders, if they've been trading in the last 2 months, the last 50, 60 days, if they've been holding on to Bitcoin, they've been losing money. They don't do that. They have to trade other stuff, right? I mean, they're out of business for the last 60 days.
If Bitcoin hits an all-time high, and then you trade out of Bitcoin into 3, 4, or 5 other trades, and you turn another 5 or 10x, or say it was Z Classic and you did a 50x or whatever that was, 15x, you don't really care if Bitcoin goes down 72%. Maybe you cash out, but probably don't. You don't care if your holding goes down 72% if you just 15x'd it.
But they're not making money in Bitcoin. They're making money in everything but Bitcoin for the last 2 months.
They just made a bunch of Bitcoin. They just tripled, quadrupled, 20x'd their Bitcoin holdings. They don't care how much money they made. Bitcoin is worth more than money. I'm elaborating their perception, the mentality.
Back to the Bitcoin bias, because I don't agree with that.
Yeah, well, you may not agree with it, but what you have to realize is any bear in the market has that, right? Even you actually have it. Even if you say you don't agree with it, You bought into this because you got the concept of Bitcoin and why this is valuable, and you're transcribing that perception over to all these alts in that same vein, and it's just it's a dangerous place to be.
That's where the wave theory comes in, and it's so important because you can shift out of. Not every coin will have the same wave at the same time.
So what if Ethereum fails? How many of those coins are built on Ethereum?
Well, I'm not expecting Ethereum to fail any more than I'm expecting Bitcoin to fail. It's a
Why not? Ethereum's been around for 2 years, and it's had at least one hard fork, and there's like, I don't know, $130 million worth of Ether locked up that can't be released without another hard fork.
You can say the same thing about Bitcoin. Any coin could fail, right?
No. Bitcoin hasn't forked.
Oh yeah, Bitcoin is forked.
No. You're not understanding. Ethereum forked the chain because of a hack to a contract.
No.
Right. So
Bitcoin has not forked. You're talking about one blip 8 years ago, and 184 billion Bitcoins were created, and then they fixed it right away.
So the distinction, Roger, that I think he's making is that none of the Bitcoin forks have rewritten the blockchain.
Right.
They've taken it from the fork forward. Ethereum has forked once to correct what it was perceived by the community as an error that should be corrected in the blockchain.
So the current live Ethereum chain is forked.
But it doesn't matter.
Bitcoin chain is not forked.
Software.
The current.
Wait a minute. It's all software. It doesn't matter if
you have to compare apples to apples.
Or if you fork and roll back, it doesn't matter.
Okay, but it does. It absolutely 100% does, because if the community can fork the chain, then it's not immutable. And if it's not immutable, then you cannot trust it to be valid forever.
So I think you're using fork in a context that
right, it's confusing, and that's what I'm trying to clarify. So
yeah, so if the community can
not valid forever, I'm okay with that, because it's just software and it's got to evolve.
No, because Bitcoin has no value if you can't trust the economic policy that it's built on and the immutability of the ledger. That's the only thing that gives it value to begin with.
Well, you see, there are different types of trust. You may trust in the fact that it's immutable, which is if you believe in the stone tablets of the 10 Commandments that came down from Mount Sinai, nothing's going to change those 10 Commandments, and those become immutable. But if you believe
that's not immutable, they're not encrypted.
Well, they're
not immutable. Right? Somebody can make a copy of a stone slab, and they can chisel something to it, and they can pull it off as a counterfeit. That's the
but I think to Roger's point, the code that runs the blockchain is mutable. It's not encrypted, right?
Absolutely, the code is mutable. But the whole purpose of decentralized money that's not controlled by anybody is that it can't be controlled, right? But if a central foundation can change the history of the record, that completely violates that trust from the community. And now it hasn't happened again, and they won't. They're really trying very hard. So there's this parity glitch that has 130 million or something. Maybe it's worth less now, but whatever it was, $100+ million worth of Ethereum locked up in it because of a glitch that basically there was, an error, right? And the only way to fix that now is to fork the code. That is a symptom of Ethereum being not battle tested, right? Not world ready, not a 10-year-old secure chain.
No,
it's a symptom of the complexity being
a symptom
greater in terms of the. I'm sorry, I'm going to cut in here. It's an indication of more the more stuff you have in a system, the more opportunity for it to get broken, right? So Ethereum is far more sophisticated code base because of its ability to do smart contracts and even things like ERC20 coins. So there's a lot more opportunity for there to be bugs in the code that haven't been revealed yet.
All the more reason to maybe not trust it as a secure store of reserve value in a brand new market.
But I will point out the bug is not in securing the funds, the Ether that underlie the Ethereum blockchain. The bug was in the execution of smart contracts that caused that 130 million to be put in the wrong place or stranded, right?
Correct.
Now that it's there, it's securely there, and it ain't coming out without a fork, right?
Right. Yeah, exactly. And so my point to all of that is recognizing that there is a core fundamental technology that combines open source software called blockchain, token economics, and a transparent, immutable ledger and monetary policy. Those things come together that make Bitcoin valuable. And that's what makes the core underlying asset as a reserve currency valuable. When you look at Ethereum, all those concepts are in play, right? They have a transparent, immutable ledger in theory. They have a transparent monetary policy and how those coins are issued and handled. And they have the open source software that proliferates and is decentralized. But to what Stephen said is there's a lot more complexity in that system and a lot more room for failure. And as a reserve, you want something that is at least correlated to other things around it and is most secure and reliable. And so that's why it's so key to understand, whether you believe it or not, or you embrace it or not, to understand that you're dealing with a decade-old community that perceives it that way. And there is a very strong technical argument for why it should be looked at that way. All of these coins out there are nowhere near the same class of risk as Bitcoin. They are exponentially riskier than buying Bitcoin or buying Litecoin.
I don't know about exponentially, but I agree with you that they are riskier. And you know, we're not disagreeing on that. I still see Bitcoin as a store of value. I haven't said Bitcoin's no good. Sure. I just said Bitcoin is not the only coin that's good. And you know, there's a lot of benefit to innovation. You cannot embrace the future. There wouldn't be a Bitcoin if somebody didn't put out the code. And Bitcoin had its own issues when it started. It had to be road tested. So you have to applaud Ethereum for adding smart contracts. They push the industry forward. That's the reason why Bitcoin's looking to add smart contracts, right, with the rootstock.
Well, that's not the reason. The people who have Bitcoin have been working on smart contracts for a long time. Ethereum just was smart enough and got some money behind them so that they could push it to market faster, and they made it to market first.
This is what innovation's about.
Absolutely.
And that's what we're doing. So it's not like there's only one coin. So I have two responses to your points. One is diversified portfolio. You don't have to own just one. You can own more than one, and you can allocate your risk depending on the value of the coin. I agree that Ethereum has more potential for security risks. I agree with that, but it doesn't mean I wouldn't use it, and it doesn't mean I think it'll fail and go away. I think they will fix it. It's just software. They will fix it, but there are some risks with using it, and I think that's reflected in the price. It's why Ethereum is number 2, and it's why Ethereum, in my view, is not going to overtake Bitcoin in the near future, at least probably not this year. So I agree with you on that, but I don't think it doesn't have value. It's number 2. It's just not number 1. And there's a huge amount of value. Each coin can have a different use case. There can be dozens of different use cases. Bitcoin can be a store of value. Ethereum can be, an exchange medium. It can be an ICO platform. It can be smart contracts. It can be a test bed for all this new stuff that creates security holes, but at least somebody's testing this stuff out and we figure out where those holes are, and the next implementation will be better. And other coins like Litecoin, it can be the payment system. Dash can be a payment system. So there's a use case for every coin. And also, none of these blockchains are really fast enough or cheap enough that they can hold all the traffic. So we want multiple coins. So the first answer is diversified portfolio. We need it. Second is democratization. So really having all these coins out there encourages and promotes democratization. If we just have one coin out there and it's controlled by, well, let me put it another way. Your concern was that a coin might be taken over by a group, so that if it didn't have, if the developers and the miners could change the code, it wasn't immutable, and there was this risk that it could be taken over. Well, I don't believe that the code has to be immutable, even if the blockchain is. I think you can change the code and evolve it, and I'm not afraid of that process because of democratization. I think that you have these broad-based communities, and their strength is the price of these coins are reflected in the strength of those communities, which is why I agree with you. If you look at the coins that are being mined, if you look at the coins that are decentralized, I think both short-term and long-term, they're likely to have higher value. Right? And there are some exceptions, you know, Ripple, but still, I think over the long term, I think people will recognize that the democratization is part of what gives those coins values. And it's also our safety valve, so that I don't worry so much that if somebody can change the code, that they suddenly can hijack the coin.
Yeah, I get what you're saying. There's a democratization in there being more coins in the market, but also the more contributors to a single chain is democratizing it and more decentralizing it. The principles of the decentralized network are democratizing. And so arguably you could say any diversion from work on the central chain is weakening the protection of that central chain from outside influences.
I don't agree with that, as long as you get a strong community, because if the community doesn't agree, if you don't have a consensus among the developers, then they're not going to change the code. So as long as you have a very broad, diversified community and it's a decentralized coin, people will vote with their feet. And if they don't like what the community is doing, they'll just go to another coin.
Yeah, that may be the case. I mean, it's an economic tool. When we start talking about different projects and things like that, you know, what a community is doing might be important. But at the end of the day, when we're talking about an economic tool, we're talking about the functional effectiveness of it. And only time will tell. But the most successful coin, most successful blockchain will be the result of the most participation. And the way to protect that is to have maximum participation. You know, the idea of the whole blockchain is to put everybody on the same playing field so that competing parties have a, you know, either a disincentive or an incentive to cooperate. And so the more parties involved in that circle, in that pool, the more stable, the more decentralized, the more resilient that network is. All of these different systems can be built on top of one another. They can all interconnect. And so it's just really important to watch those relationships. Okay, there's a lot of these ICOs and alts out there that sound like great projects, and they're nothing. They're doing something that's going to be completely redundant or unnecessary 18 months or 3 years from now because of some other evolution in the market. There's very few that are really doing something, you know, of value. And then some of the ones that are doing stuff of value, all they are is good companies with a token attached. So honestly, to your point, Roger, some of those might be less risky than Bitcoin in the simple fact that they're actually a more traditional business investment. They're just represented by a digital token, right? And so it doesn't really matter what the blockchain is underlying it, because you've got protection from, you know, US federal securities laws because you bought an investment from a company.
Well, yes,
so
no. Yes,
arguably,
no. But we're talking about billion-dollar valuations, you know, $100 billion, $200 billion for, you know, Bitcoin.
Oh, you can certainly lose your money. Absolutely.
Well,
just like you have any investment.
But just to, you know, I agree, you know, that it's great to have companies that are building real products and services and they're doing things and they have value. But those are distributed applications. And they're like real businesses, but they don't justify the kind of valuations that Ethereum and Bitcoin have.
Right. Right. Yeah, absolutely.
Because, you know, if you think of the biggest companies in the world, what takes it to that next level is the network effect. It's the pure currencies. So I think what we'll see in this next evolution of cryptocurrencies is people will, and it may not happen right away, because a lot of this is complicated for the average person to dive in deep what each coin is doing. The project doesn't even exist. They don't even know how it's going on.
Yeah.
But what will happen maybe, you know, next year or 2 years, people will start to see that some of these coins and applications, they are limited based on their business model as to how much money they can make, and that the price should reflect that. And others, they'll start to see the network effect really kick in. That when you look at Bitcoin, well, Bitcoin created a monetary system that never existed, where people could take money from country to country, where people could use money in new ways, where they could cut out third-party intermediaries. That exchange medium, and there aren't going to be a million, you know, exchange coins with Bitcoin, Ethereum. There are going to be a certain number that everybody accepts and they use and they recognize. And those are going to have the strongest network effect. And because it's a global network effect, or maybe if there are aliens out there, universal network effect, then, you know, those are going to have an order of magnitude greater value than just the distributed application. And that's one of the things that I'm sort of excited about seeing emerge over the next couple of years.
Absolutely, absolutely. I think it's key to kind of keep isolating these into different categories, right? It's too easy to get.
The use case is really important.
Yeah, absolutely. So how's the data feed been doing for you, Stephen?
The data feed?
Well, your chart analytics. You were commenting on the MACD earlier in a message, I think.
Oh yeah, so I actually, I'm probably a bit of a Bitcoin pariah because I popped out of all my BTC back when it was around a little over 9,000, and I went back in a little bit today when I saw signs of a turnaround and recovery. Volume was picking up; it was positive. We were back up to the 200-day moving average support level. Or actually 200-hour. I was looking at the hourly charts.
Yeah. And
the MACD was showing a little bit of convergence. So it's holding so far. I mean, that was only 4 or 5 hours ago, right?
Yeah, right. Yeah.
But, we've been up and we'll see what comes of it.
Right. Yeah. Ethereum's been hanging right around the 0.1 mark against Bitcoin, which at 0.5 is when it, surpasses the Bitcoin market cap. So I really question how much further it's going to go. It got up to 0.12 and I sold it all.
Oh, really?
I might. Well, I mean, I have a little bit, but I'll probably. I keep thinking about buying back in now. I saw it dip down to 0.94. Almost bought some back in, but didn't pay attention for long enough.
So I'm going to pull up that.
And Litecoin, I think I sold all my Litecoin the other day too, and I'll wait for that to dip back down.
Yeah, I got out of the Litecoin too.
Wow, it did dip back down. If you weren't buying at $100, you missed an opportunity. I don't ever expect to see it below 100 again.
No. I sold it for Bitcoin at 0.018. Well.
Let's get our reserve currency correct here.
Yeah. My trades are all in Bitcoin. I basically, yeah. Looks like. Essentially, it worked out to like about a 20% on either of them.
So, speaking of that, the reserve currency concept, right, with Bitcoin, that kind of speaks to the whole coin market cap ranking things, right? So the market capitalization is always reported in U.S. dollars, and I've been looking at the ranking distributions as a power law distribution, in U.S. dollars. And was noticing, something anomalous developing in terms of the models don't fit the Bitcoin and Ethereum relationship, right? It looks like Ethereum's kind of creeping up on Bitcoin, right? It's a little high for its number 2 position, or Bitcoin's a little low for its number 1. But if you think about Bitcoin as the reserve currency, then I should just be looking at the next, 100 coins below that in terms of their value versus Bitcoin. It's another way to look at it. So, however, I will say this: when you look at it with U.S. dollar as reserve currency, it still follows a nice power law distribution with Bitcoin in there.
Right. Yep.
So, I should probably look at all of the fiat currencies with the U.S. dollar as the global reserve currencies and see how they stack up.
Yeah. Oh, interesting. Absolutely.
Like the M4.
Yeah, and I'm really curious. I haven't paid any attention, but I'm curious to see what kind of variations you can see between currencies with Bitcoin too. Because I never pay attention to it, but they have euros on and British pounds on GDAX, and I never actually pay much attention to it. I did for a while when I was only watching Bitcoin a year and a half ago, but when I started watching a bunch of other assets, I stopped paying attention to the fiat
I've
currencies.
noticed a couple times in the last few days when I've gone on GDAX and just kind of, when you're clicking the selection of which coin, I noticed Bitcoin and Ethereum relative to the euro was in the green a couple of times when it was still in the red on the US dollar chart.
Yeah.
But that might have something to do with the fact that the US dollar has been strengthening relative to the euro too, right? So
right.
Yeah. Three-way interplay going on.
Yep. Yeah, and I've seen interesting things with the yen a while back before China banned, started doing all their crazy stuff. But you could see huge differences swing in the yen price of Bitcoin.
Like right now, relative to the euro, Bitcoin's up 10% in the last 24 hours, and only up 8% relative to US dollars.
Oh wow!
So there's probably an arbitrage opportunity there somewhere, but
yeah, I'm not going to play
weeds
that.
for me to worry about.
Yeah, absolutely.
So what that means is the dollar is strengthening. I think those periods of the dollar strengthening are going to be short-lived. So, don't get me wrong. I find it still easier to, at this point, to compare with U.S. dollars because when you have Bitcoin dropping 70% in the last 2 months, it's really hard to get a sense, particularly if you have to pay your taxes and your mortgage in dollars. It's really hard to get a sense of whether your portfolio is increasing or decreasing.
But you're not going to not look at it in dollars. You're still going to see it in dollars. That doesn't go away. Your instinct is to perceive things in dollars.
But your trades, the relative trades, you ultimately, if you want to figure out whether you're ahead or behind, you can say, well, I've got more Bitcoin. But if Bitcoin has just crashed 70%, it doesn't feel as good as if you have more dollars during that period because the dollar's not fluctuating as much.
Well, again, that's all about perception because I've learned to feel just fine with my Bitcoin balance, even when it goes down by 70% in US dollar value. So,
well, don't get me wrong. I measure my success based on the number of Bitcoin, that I have today versus what I had, a month or 2 months ago, and I like to see that number going up. But you still have to make, smart decisions.
Absolutely.
Well, mine went up 25% just by selling a week ago and buying back today.
Yeah. Awesome. That's it.
That was smart. What made you make that decision, Steve?
I was quickly passing the point where I couldn't. It's fear.
Yeah.
It's fear. I was quickly approaching the point where I wouldn't be able to recover my original fiat currency investment.
Yeah.
So I said, you know what? I'm going to pull that out where it's liquid on GDAX. That amount. I still had stuff, on Poloniex and in my MetaMask wallet and Exodus and wherever else. But I was able to scrape out my original US dollar investment in the whole space at that point, and just made the choice to do that so that, if I have to answer to family and friends about did I lose my shirt in the Bitcoin crash, I could say, no, I'm still up. I got all these coins in my back pocket and I got my original investment back.
So you protected the principal, but then you put it back in.
Put some of it back in.
Put some of it back in. So
the chart spoke to him.
Yeah.
So have we hit the bottom?
Some of it's back in a bank account and it's not available for another 3 days.
So these are different views, right? So I take the view that if I look out a year, 2 years, or 5 years, it doesn't matter because I'm going to see higher highs and higher lows. Bitcoin, cryptocurrencies, the best ones, they're going to be higher. If I'm going to make a mistake, my bias is to make a mistake by holding it rather than getting out. So, but I understand, wanting to protect the principal. But then the trouble you have is knowing when to get in and not being shaken out again, right? So you made a good move. If you can buy low and sell, if you can sell low and buy in lower, awesome, right? But if it takes off at some point, you may or may not be able to catch up.
But I sold high relative to when I bought to begin with.
Right. Exactly.
And actually, I was doing that on all the way this thing was going down. I would sit at my computer for a couple of hours each night and just ride the oscillations and sell a quarter of a Bitcoin, buy it back 2 hours later, sell it, and was just kind of ratcheting up my Bitcoin holdings during the
fluctuation,
during the last 2 weeks of riding down. But then I got tired of it. It's just like
time consuming.
It's a lot of work for, what mounted to maybe $100, $200 a night, right?
Yeah.
I mean, on each oscillation. I wasn't trading huge amounts because I didn't dare put that much at risk on the bet of the next oscillation.
Right.
And that's the debate I had with my son for a long time, is that, you can make money doing it, but you have to spend your life sitting in front of the computer to do it.
And I was thinking about, so I'm in the middle of doing my income taxes for 2017. And I was also thinking about what's this going to do to the amount of time I have to spend on my income taxes in 2018.
Yeah, it's incredible.
And I started thinking, you know what? My hourly rate is going way down.
It's incredible. So this is where, again, where the wave theory comes in. This is all about my trying to avoid these problems, because I think everybody has to go through those, you know, spending 2 days just staring at the screen, trading in and out, just so that they have the experience and develop some charting skills. I think that's incredibly valuable, but it's not scalable, and there isn't a lot of satisfaction unless you want to be a trader. You want to have a life. Right. You don't want to be watching the screen all the time. Right. And so you have to come up with a diversified portfolio so that you don't have to watch it all the time. And then ideally you want to maximize that portfolio, and that's where the wave comes in, because what we're seeing is extreme volatility. So if I look at where it was in November, and Bitcoin, if you look at where it is today, Bitcoin started in September at 3,000. Today it's at what, 7,000? So that's like 2.5 times. After all that, where Bitcoin traveled up to 20,000 and down to 3.5, if you just held it that whole time without trading it, you got 2.5 times your investment. Not bad, but if you'd sold it at 20, you would have gotten 7 times your investment, right? And then if you bought it back in at 6, you would have gotten another 25% or 20%. Yeah, but you
don't know when 20 is the right time to sell, or 6 is the right time to buy.
You don't know. But so this is why I'm studying the wave theory and why it's so important, because you're not going to know exactly, but you can start to recognize some patterns.
So the other pattern today that triggered me was the fact that it was decelerating. The losses were decelerating. Previously, we had a lot of humps, a little clawing back, and then it would drop again and it would accelerate. And then, like, over the last 24 hours, it kind of, my hand's going the wrong way.
The weak hands
started to go concave up, right, as it was still going down. And that's when I said, volume was increasing.
Started to slip out.
And
you felt more comfortable. Sure. Yeah. Well, so there's a lot of opportunity there if you can figure out these cycles, and you don't have to get it right. You just have to scale out as it's going up, and you have to recognize some of the patterns. And if you can do it, you're not going to get that. You're not going to get that 7x, but you might get 5x, and that's a lot better than 2.5. So by a disciplined wave theory, a disciplined application of the wave theory, you can improve your return without having to do all the trading, without having to do the day trading. And that's the goal of it.
Right. Yeah, absolutely. My tendency is to basically just watch for volatility and find something volatile to trade. I mean, something that I like, right?
That's a trader's mentality, though.
Yeah. I mean, if it's Litecoin, if it's Ethereum, whatever it might be in a given day, either it looks like it's going to, the volume is going to increase and it's going to go through a heavy spike, or it's going to go down. Like, Ethereum, like, I'm debating if I should buy it back now. I should have had a limit order in there, but I didn't. I bought it back at 90.095. But I also anticipate that if it's going to start going up, it'll accelerate, and I'd probably swap back in. I don't think Ether will go past 0.14, maybe 0.15, but I really think 0.14 limits it. At that point, it really hits too much resistance in the market to overturn Bitcoin, at least for now. And Litecoin, as you and I have discussed, I think has a ton of upside. So Litecoin makes me nervous to get in and out of, because it has so much more capacity to go up relative to Bitcoin. But it moves
fast.
Yeah. But that's the thing. It also, like I said, I see Litecoin as an alternate reserve to Bitcoin that I believe a certain segment of significant Bitcoin traders use that way. And so you can see certain things happen where, and they're different now than they were a year ago, these patterns, but you can see the movements where people just go back and forth from Bitcoin to Litecoin just to mitigate the impact from the market.
Definitely. Well, Litecoin was just coming on the scene a year ago, and its viability and its role, its use case was not clear. Now it's
well, I don't know about that. I mean, Litecoin's been around since 2011.
It's been around, but it was only just listed on Coinbase a year ago. There are a lot of things. There are a lot of things that, a lot of these coins have been around.
Litecoin was actually on Coinbase like 2 years ago. It just was on GDAX. It wasn't retail purchasable.
Right. So where's Litecoin in the stack up, in the rankings of total cap?
Oh, what is that, like 6 now? I was
6 or 7, yeah, somewhere in there. We can look it up.
6. Not 7.9 billion market cap.
Well, I'm just curious because I'm kind of been looking at where things sit, and one of the things that this sort of massive, we'll call it correction, whatever, breakdown seems to have done is moved what I would consider to be, and Ryan will tell me they're all, they're nothing compared to Bitcoin, but the quality altcoins kind of consolidated them near the top of the stack.
Yeah.
What's moved up in the rankings, Cardano, Stellar, IOTA, EOS, Dash,
right?
Monero is up there. They're all kind of the ones that you think have a reason to exist and have some sort of a model behind them.
Yep.
They seem to have all slid up to the top. We still have Ripple up there, which eventually maybe the world will wake up and throw that out, but
we'll see.
Yeah. So I was curious what you guys thought about what went on in the traditional markets. Did you already talk about that before I got on the line?
We didn't, but that is a great segue. Yeah, this 8% drop.
Yeah. So, and the headlines are all saying it was fears around wages rising because that's bad for business, and inflation, and the Fed raising the prime rate. But why it dropped as fast as it did is because people had to make good on all the puts that were underlying these exchange traded instruments for betting on volatility or betting against volatility, right?
Yep.
So CBOE are friends who want to be able to, introduce at least to the masses the futures trading on Bitcoin that was already available through some of the more obscure exchanges. I read up on the history of them, and they basically created the VIX, which is the 30-day volatility index.
Mm-hmm.
It looks out 30 days at all the futures contracts for puts and calls on things in it, and it kind of measures. It comes up with this volatility number. Turns out they actually created that to be able to develop derivative instruments to trade on volatility. So people are actually buying and selling volatility. And the problem with that is it's a huge, hugely leveraged bet. And what people were getting in the habit of is whenever volatility spiked, they shorted volatility on the assumption it would go back down, right?
Yep.
And on Friday, it didn't go back down, right?
Yeah.
And so all these shorts were the wrong bet, and they were highly leveraged. And so they had to actually exercise all those puts.
Yeah.
And I would also
say, it was sort of an automated sell-off. The XIV, which is CBOE's, or not CBOE's, another outfit. Inverse. It's a highly leveraged inverse volatility index.
Mm-hmm.
That thing went from 100 at 4 o'clock Monday afternoon to like 11 within a couple of hours after hours.
Wow.
And so that's what it was. I mean, it wasn't fear of the average investor. It was, well, although that came to play, right? Because once everybody saw everything crashing, they scrambled to get out. But it was the necessary sell-off of all these assets to cover the crappy, over-leveraged bets against volatility that happened.
Well, you're also going to hit some triggers because a lot of it is automated. You got a lot of computer trading going on.
Right.
Yeah.
I would say though that it was long overdue to have some kind of a correction. I mean, it's been in a 9-year bull run, and there's been no downturn. What I think is perhaps more interesting is why the stock market has been in a 9-year bull run. I mean, where it has just gone off the charts.
Well, it's
never
not a
going
bubble.
down. I agree with you. You know, you're being sarcastic, but I agree. It is not a bubble, and that's what I think is interesting about the stock market.
And not until January and February, right? It didn't have that parabolic character to it over the last year and a half. Or
no, but
or
it did
2
over
years,
9 years. If you look at the 9-year chart, that's a pretty steep looking chart. You get a real peak there. I think.
Well, you got to remember, it was starting from a low spot too.
Yeah.
No,
well, everything was oversold at the end of 2008, beginning of 2009, right? Because people had no idea what was in all that whole, you know, all of those toxic assets in terms of what could actually be recovered. They were running for the exits. The same has just happened to Bitcoin. So maybe we could expect a 9-year bull run on Bitcoin now.
I think historically the PE ratios in the stock market are pretty high, and they weren't that unusually high even in 2009. But what was, you know, there's one theory I think, you know, that's interesting to consider, which is that what the stock market is really doing, it's a real measure of inflation. And the reason why cryptocurrencies are going to be so important is the stock market is really reflecting how much money is being printed through quantitative easing and other methods. So it's really a reflection of the devaluation of the dollar and the need for cryptocurrencies. Because what's happening is the stock market just keeps going up forever. And you say, well, how can it keep going up? Well, because it's a safe haven for, you know, people who are getting out of dollars. That, you know, if you keep your money in the bank, you're going to get less than 1% of interest. So you have to put it into the stock market so it keeps it going up. And you go, wow, I'm getting 8% in the stock market. And it's like the interest that you used to get in the bank. But the whole thing is sort of a Ponzi scheme in that sense.
Mm. But I'll say, like, the way they taught us about the Great Depression, you know, when we were in elementary school, it was all paper profits, not real profits, right? So it's not the same as if it's in the bank earning interest, right? It's a
well,
there's a liquidity issue there when everybody runs for the exit.
I would debate that with your teacher, because I think you're going to have the same problem with the bank. If you don't own it, they've got fractional reserves. They're lending it out on all kinds of money. If there's a run on the bank, you don't get it either unless you get full faith and credit from the government and they just start cranking up the printing press.
Or if you're under the FDIC insurance limit.
But the FDIC insurance is just the government printing money. So, you know, it's all the same Ponzi scheme.
Well, it's you and me insuring the banks.
with our tax dollars.
Come out of our kids' and grandkids' taxes, right?
Exactly. Yeah. It's in our pensions and our Social Security fund.
Well, that was the thing. There were a lot of pensions who were actually invested in these crazy inverse volatility derivatives, right? Because they're looking for yield.
Right.
And so 2 or 3 of these ETPs just tanked. They just shuttered yesterday and this morning, last night. They're just like, we're done. Sorry, everybody who was, you know, who bought in at 100 and it's now at 10. Tough luck, right?
Yeah.
Yeah. So they just closed the doors.
Yeah.
Yeah. Yeah. Huh. It's interesting. I mean, obviously,
it's a good thing because it was a needed deleveraging.
Yeah. Yeah. But it's,
you know, and it's a good thing it didn't spread to actually bankrupt some brokerage houses and tie up a bunch of people's securities,
right?
You know, in an illiquid state.
Makes me wonder, though, you know, what bubbles there really are in the market right now, because there's got to be real estate bubbles in certain areas of this country where, you know, the recovery has been amazing and, you know, real estate prices are going up. There's definitely, you know, we've been doing a lot of lending. I mean, I know banks have been issuing lots of loans at really low rates, having worked in finance, having negotiated people loans, you know, with banks that are questionable if they're going to pay. You know, I can tell you that there's a lot of leverage out in the market right now that could very easily snap back. And you know, most of it has nothing to do with Bitcoin, that's for sure.
But what I was surprised to see was that nobody tried to blame the crash on Bitcoin.
Oh,
like,
yeah,
nobody said, you know, we warned that this cryptocurrency thing could affect the real markets, and that's what did it, right? I was really surprised that, you know, Jamie Dimon didn't jump out and say, "See, I told you this thing would hurt everybody."
Right.
Well, I don't think
Yeah.
we've seen the end yet. I think an 8% drop in the great scheme of things is not that big a deal. I remember in the 2008, the Dow dropping 1,000 points a day. That was no big deal. It happened every other day. So
No, but hopefully we'll have a little more graceful correction.
Yeah.
Well,
Yeah. Hopefully this continues
but,
on.
that's not historically. Stock markets have crashed just the way Bitcoin is.
Yeah.
Well, yeah, but it was accelerated,
Graceless.
I think, by those volatility derivatives, and since those have shuttered, and there's going to get a lot more scrutiny now. There's at least that factor's been removed, so now it'd be sort of a more traditional, crash.
Now, the other theory I had too was that this just coincided with a bunch of people getting out of the traditional markets to get into cryptocurrency.
I think it coincided with a bunch of people getting out of cryptocurrency and getting into the conventional markets.
Well, I think that was the spike in December.
Well, if you look at the last month, right?
Yeah.
That's the mirror image of the decline in cryptos, right? The parabolic shape of that curve, and that drove up volatility, which is what broke those inverse volatility instruments.
Yep.
And so I think there is an indirect causation there, possibly.
Yeah, I agree.
But
it's hard to say. Yeah. I would imagine the cryptocurrency market is still relatively small compared to the financial instruments, the traditional financial instruments. So it's hard for me to believe that it's having a direct effect. It could be.
Well, we just saw, I mean, the crash that we just saw in Bitcoin was literally money walking out of Bitcoin because it didn't go into other cryptocurrencies. It did in December, a little bit in January, but mostly it just went out. And so to the tune of billions of dollars, that's a pretty substantial impact on traditional markets to just flow into whatever, that flowed into.
We don't know whether it's we don't know how much money flowed out, though. I agree with you. Money flowed out, but we don't know how much because it crashed so fast that if a few people sold and the price dropped 50%, that money, a lot of money hasn't flowed out. It's just that a lot of, the valuation is.
Well, no, it has, because you can look at the volume and see the volume sold.
Yeah.
I mean, you can't know what's sold and what's bought, but you can see on a high selling day the volume, and then you can see as the price comes back, the volume come back up. The price doesn't go back up as high, but the only same amount of Bitcoin roughly gets bought. So there's a profit taken off the table.
Volume that's trading between. Right, that works both ways.
Absolutely. But what I'm saying is that, say, if it's at 20,000 and 400,000 Bitcoins are sold off in the course of it, or move back and forth in the course of a day, that's a really high volume day, mostly sales. And then you see relatively low volume, a relatively low price increase, but you see that volume coming back up. That capital that was taken out, buying back in, roughly the same number of Bitcoins are going back and forth, but somebody's taken profit off the table when they sold at 20 and 18 and 17,000. Those billions of dollars didn't go right back into the market. Otherwise, we'd have seen a quicker, faster recovery. The fact that it went as low as it did indicates that some people actually took their profits off the table and invested. I mean, if I was in a slightly different situation, I would have taken, as a self-employed individual, like $60,000 and thrown it into an IRA.
Definitely cash has been leaving, right? You don't buy a former military base in Puerto Rico or a hotel or a whole city block without taking some fiat currency out of the system.
Right. Exactly. And some of these people accepting Bitcoin for purchases in these luxury transactions, they're going to liquidate some to put cash in their pocket. They're not going to keep it all, typically. So those are the cash outflows that are all happening after this banner year where it went from $1,000 to $20,000. There's going to be some profit taking. There's going to be some re-diversification. These, college kids that just turned into millionaires, or, even if they just made $100,000, their dad's pulling their hair out going, put some of that in the, Charles Schwab.
Well, I think one of the things we're going to find is this big drop from 20,000 down to 6,000 is when we look back, 6 months, a year, 5 years from now, I think this will be a historical drop in Bitcoin. I think that there will continue to be a huge volatility. Yeah, and I think we'll continue to have 30-40% drops, but a 70% drop over the the last 2 months, I think that's going to be historical. I think we'll look back and you people will say, oh yeah, I remember when Bitcoin dropped 70%. If you haven't lived through one of those, you have never lived through cryptocurrencies. I think people will be talking stories around it, and this will be, you know, if we make it through this one, you know, you can make it through anything.
Yeah. Yeah. Well, I think that's how like real Bitcoiners feel about 2013 to 2015. So
yeah,
that's the longest drop, and by the largest percentage.
For the current generation, I think this is a whole new generation of Bitcoin survivors.
Absolutely. Absolutely. Yeah, this is definitely quite the tumble. So I think we've hit our hour. I appreciate you guys joining me. This is always an excellent conversation. I look forward to joining you guys again. I think next week we may not do this, but I imagine we'll be seeing you guys in the State House on Friday.
If I can make it.
All right. Awesome. Well, keep in touch. Keep posting on the meetup page, and we'll keep this conversation going.
Thanks.
Have a great night. Thank you, guys.